Good afternoon, everybody, and welcome to our webinar this afternoon, Measuring and Moving Key Performance Metrics Through Benchmarking. Today's presenters are Kate and Brad, but before I pass it over to them, I wanted to do a few housekeeping items as usual before our presentation takes place. So you can customize what you're seeing on the screen by going to the GoToWebinar screen viewer, maximize the webcams or the presentation, whichever you prefer. We do have the handout available for download in the handouts section of the GoToWebinar panel today, so you can download what Kate and Brad will be walking through during the presentation. For questions, we do ask that you insert your questions into the questions panel. We do not monitor the chat box during the presentation. However, if you think of a question during the survey that will come up during the end of the presentation, leave the questions in there and we will have Kate and Brad address those accordingly. We will be offering CPE, so we will have 3 polling questions today. We do need you to answer all 3 of those in order to receive CPE. And our CPE comes from a third party called Simple Certs. If you do not see those in your inbox within a couple business days, check your junk and spam folders, as sometimes they like to fall into there. And if you don't receive it after you've looked in your junk and spam, please shoot us an email and we will resolve that as quickly as possible. And speaking of our survey, please let us know how we did. That will pop up after the presentation concludes today. Insert any questions that were not answered, and that is also where you will select if you need that CPE credit. So without further ado, Brad, Kate, you can take it away.
Thanks, Kaylee. Appreciate it. Hello, everyone. This is Brad Wilson, and I will be joined shortly by Kate Allen. She's experiencing some technological problems on her end, and I expect her to be arriving here any minute. Well, matter of fact, there she is.
Yay!
Let's start with some introductions then, Kate, if you're connected and ready. Well, no, actually, let me go first. So many of you, if you've attended StandBall webinars, probably have heard me, seen me before. I'm Brad Wilson, as I mentioned, accountant by trade, consultant by profession. Been with inside the AE industry as a CFO or consultant for almost 30 years now. Focused on financial issues, obviously, as a consultant, financial management, ownership transition, mergers and acquisitions. And benchmarking, the subject for today, has an impact on all of that. So Kate and I decided to team up and give you some good information this afternoon about how to do benchmarking and use it. So Kate, please, from there.
Thanks, Brad. Glad to be with you all finally. Sorry. Kate Allen, by trade, I guess. I'm a mechanical engineer, but I'm also a consultant. With a little bit of an unusual background in that psychology degree and engineering degree and MBA. So I get to put all that to work here. But most importantly, I guess with all of the consulting that we do, I believe wholeheartedly in benchmarking. And one of the things that I want to encourage everyone as part of this webinar, we're going to send you, after we send you the recording, etc., we'll give you clicks to, or we'll give you links for surveys that are currently open, and hopefully you'll participate. The more data we have, the better information the industry has in order to benchmark themselves against. So that's one of the key priorities today. So thanks, Brad.
Great, Kate. So major learning objectives for today, if you saw them on our promotional material for this webinar, the connection between financial statements and KPIs, that's key performance indicators. I'll use KPIs a lot, we both will. That's what it means. Then of course, how we manipulate, turn the levers, push the levers to manage our AE performance, firm performance through that benchmarking. And then how to use your benchmarking data to actually impact the performance of your firm through the performance of your people. So those 3 things will be why we are conducting this webinar, but we want to start with the why behind the benchmarking. Going back to a survey of StandBall Ness's AE clients, we asked what's happening in your firm in relationship to the potential downturn in the economy. and improving project financial performance, making sure that the firm is running at top notch, hitting on all cylinders was right at the top of the list. And of course, unless you know exactly where you happen to not be most efficient through a benchmarking exercise, you may be working futilely, right? There may not be a good feedback on that. So what's the biggest challenges in your firm have kind of been the same for a long time in different proportions: people and projects. And really, those are the two most important aspects of managing any AE firm. We all know that recruitment of staff has been at the top for a long time, and wage growth and retention, project profitability, of course, and benefits, increasing or decreasing profitability as a firm. All of these things are directly related to the exercise or can be influenced, changed, managed through an effective benchmarking program. In improving the performance of your firm, we're going to talk about the first two boxes here, the benchmarking section of the overall performance continuum here. We'll start with a gap analysis of where are we today and what needs to change based on how our metrics measure up to our expectations and the standards in the industry. Then we'll talk about how do we take that data and apply it in our firm through our people in order to actually impact the performance of the firm. Now, how you do that from a marketing point of view, which markets, which people, those types of things would be in a performance strategy webinar. And we'll follow up with one of those down the road sometime, I'm sure. But the whole idea is the anticipatory thinking being applied to the future vision that you have for your firm. We'll measure where you are today in comparison to where you want to be, educate you on what things behavior-wise need to change in order to make those numbers change. But then the next step beyond that is putting those steps, those tactics in motion with your people in an intentional way, usually through a strategic plan, to create that future firm that you see in your mind and that you want to experience, financially, professionally, your best picture of your own firm. Okay. Now, need to start the definition of key performance indicators, the ratios that we're going to share with you, as opposed to your traditional financial statements. Okay. It's important for firm-wide managers to know what is on a financial statement and what these mean. And you've probably heard us go through other webinars about what's on a balance sheet and what's on an income statement and why are they used and all of that. That's not what we're talking about today. You need that data, obviously. It's important to have very accurate and timely data to help you with your benchmarking, but the value lies in the ratios between those categories of line items, let's call it accounts, values in your financial statements. And we'll go through, without stealing thunder of future slides here, we'll go through many of those ratios that are most important, we believe, to your financial and operational health. But you track that performance on a month-to-month, quarter-to-quarter basis, certainly year-to-year, and then benchmark those to industry peers or yourselves or the circle of excellence. The standards that are out there kind of set the targets at various times for different firms, and whether you're a civil engineer, an architect, West Coast, East Coast, all of that is benchmarkable data. Now, before you dive into the numbers, however, I'm going to kick it over to Kate, and she's going to tell us why words matter.
Thanks, Brad. There's a picture of Starbucks here with intention, actually. And what I've learned is that in trying to teach people about finance, or even when we start digging into benchmarking, is that often people don't really know what the words mean. They don't know what revenue or gross revenue, net revenue, income, earnings, all those different things. Where do they show up on the income statements? And actually, I ran into that same problem. When I was in my MBA, I was 4 chapters in before I realized I had no idea what I was talking about. And I realized that the words are critical. The words have meaning, right? Gross revenue is at the top. Net revenue is what the money that I have to pay my bills with. So we wanted to we'll start with some definitions. Anytime we do a webinar related to finance, we try to start with some definitions. Some of them many of you may already know, but If not, it may give you a simple way to share it with your teams back in your office. So with that, we're going to move on to our first polling question. So
Kaylee, watch that.
yeah, thanks. There you go. So on average, each person in our firm receives X amount of hours per year in financial business training. So pick one. So less than 5 hours, 5 to 10 hours, 10 to 20, 20 to 40, and more than 40.
Alrighty, so it looks like already about 70% of our crowd has voted. We're waiting till about 85% have voted, or if a minute elapses, whichever one comes first. And everybody's wide awake this afternoon because we're already at 87%. So I'm gonna go ahead and close and share this so everybody can see the result. And there's an overwhelming response of 71% say less than 5. 21% say 5 to 10, 4% 10 to 20, 2% 20 to 40, and 1% more than 40.
Kate, it looks like we attracted the right crowd.
Yeah, it's not uncommon, right? We're so busy getting projects out the door that it's not uncommon, and it's not atypical at all. But we would hopefully encourage you to start sharing more of this information with them. And we'll, at the end part of this, we'll actually talk about transparency and what that means. So this is an image just to really capture what the AE business model is, right? We do the work, it turns to an invoice, and then hopefully if it's collected, it turns to cash. And out of that cash, we're going to pay our project-related costs, our operational costs, which are those costs that we use to run our business, our rent, our insurance, et cetera. And then what's left at the bottom, it's left after all is profit. So just a real simple model of what we do for a living. So the income statement, basically we consider this the scorecard of all of your operational decisions and all of your project related decisions, to be honest. So it's always rear looking. And in a nutshell, it's basically your revenues, which are all your income. Again, the words income and revenues and that kind of things have different meaning. Revenues, right, is until it hits an invoice, it doesn't become revenue. And then we have to pay all of our expenses out of that. And then what's left over is our net income. And when you're talking about net income, you have to be very specific. Is it before bonus and taxes? Is it after bonus and taxes? So something to think about is when you get to net income, you have to very clearly define. The cleanest, purest one is just take your revenues minus your expenses, and that will tell you the money that you basically have to work with for bonus and taxes and other items. So gross revenue is your firm's direct labor costs, plus your sub-consultants and all of those pass-throughs, those reimbursables, whether it's travel, meals, et cetera. So that becomes gross revenue. In the architecture world, gross revenue is usually quite high. Net revenue is then when we take the sub-consultants and we take the pass-throughs and reimbursables out, that net revenue is what we actually have available to pay our bills with. Assuming we collect it, right? It's become net revenue on an accrual-based statement because we've sent an invoice. But assuming that net revenue is all that we generate from our own people, our own labor, and it's what we can basically pay our operational expenses with and create profit from. So, you know, as much as I hate doing my own timesheet, we'll just talk about why timesheets are so important.
We were due yesterday, by the way, right?
So why timesheets are so super important in our industry. So again, we keep track of where our labor costs go. That is our widget, right? That is the components that we put together to create our widget. So it's our labor. Where does our labor go? Not where do our hours go, but where does our labor costs go? So anytime we get a timesheet in, we need to look at it and decide how much of that person's time was spent on projects, and that will be the direct labor side, so project related costs. Anything that is not project related goes to the indirect side, and that's going to become part of overhead. So that'll go into your operational costs. So when you get someone's timesheet, let's say that we pay them $50,000 a year, let's say it's $2,000 in this pay period, whatever. And let's say that, I hope I can do the math really quickly, but let's just say we paid them $1,000 this pay period and 60% of their time went to direct labor. Then I would expect to see $600 allocated to direct labor, and I would receive $400 allocated to indirect labor. And we'll keep track of that in our operational costs. Our direct labor is actually in our cost of goods sold, right? It's our labor that produces our product. So accurate timesheets is extremely important. When we get to expenses, there are two types of expenses basically. There's the project-related expenses, sub-consultants, travel, meals, lodging, those kinds of things that come with the project. And typically those will be reimbursed and those will be passed through. You may do a markup on them, you may not. And then there's everything else. There's our operating expenses. It's all of our overhead labor, which is our indirect labor. It's our benefits, our technology, marketing, education, professional service, and more. It's everything that we've decided to pay for in order to run our business. And so when I started my own company, my own MEP firm years ago, somebody told me the number one thing is keep my overhead low. So managing this is critically important, and trying to keep it reasonable, and you can benchmark this. And so you can find out later, we'll show you what the numbers look like, but keeping that overhead low is incredibly important. And the biggest factor in there is your indirect labor typically. So really making sure that we're getting good, accurate information from timesheets is absolutely critical. This is just like a real big overview, like a seriously rolled up income statement, let's say. It's been rolled up to just the general. So we have the gross revenue. This is the top part is about producing projects, right? So this is our basically getting our product out the door. We have sub-consultants and reimbursables that we will then take out of our gross. We'll come down to net revenue, and then we'll keep track of our direct labor because that's basically going to be contribute to our cost of goods sold. When I take my net revenue minus my direct labor, I end up with gross profit. Out of that gross profit line is where we pay all those operating expenses until we get to operating profit or net income, whatever you want to call it. Again, the words all matter. I think one of the most important things here is to really track that direct labor because that is the cost to produce your product. And so not accurately tracking that, and it's also the basis for most of the benchmarking. So not having an accurate number for direct labor can cause you a lot of problems. The balance sheet is really about the financial health of the firm. We look at assets and liabilities, and just like the name says, it has to balance assets at basically equal your liabilities plus your shareholders' equity. On the balance sheet, just one note, we're going to talk about work in process. We're going to talk about accounts receivable. Those only show up if you do accrual-based statements. So critically important, we should be running our company on accrual-based statements. And then obviously we need to keep track of our cash-based statement as well. But managing the business comes off of the accrual-based statements. So what's work in process? Really, a lot of companies for a very long time, I worked with a lot of companies that never tracked this. They just like, yeah, we have it. Yeah, we don't worry about it. And instead, what we would like to encourage everyone to do is make sure you put this on your balance sheet. And so basically what it is you have your firm's direct labor costs or your direct labor costs. It's hit a timesheet, but for some reason it has not gotten to an invoice yet. So we have to proactively track, monitor, and manage that. That is just as good as cash. It just hasn't gone to an invoice. We haven't asked the client to pay us yet. But what we've done is we've done the work. And many times, I know as an engineer, my team would put stuff on hold and put it on hold and put it on hold. And some of the reasons might be because they got ahead on the project or because they did some work that they're not really sure they haven't gotten out and gotten a change order for yet. I mean, there's a lot of reasons that people hold things in WIP or work in process. But it's critically important that you manage it. If there's going to be write-offs, you may want to have a policy to say, hey, we can write things off in here because we can't carry things that will never get to an invoice, but that has to be approved by management. And so really getting things out of WIP and over to an invoice is really what's critical. So we want to keep that time period as short as possible. So WIP basically converts over to accounts receivable when it hits an invoice. Now I've sent an invoice and I'm asking the client to pay. So now what I'm tracking is my accounts receivable. I'm tracking my accounts receivable and hopefully to get it with the intention to convert it to cash. So similar to WIP, we need to manage it. We don't need to let it age. If it's aging, we need to know it's aging for a reason. The same thing once it's gone out of the invoice. If we have accounts receivable, we keep track of how old that is with our AR aging reports. And then if there are things in there that you've been holding for months and months and months, and they may turn to cash, it's still better to write them off and then consider that a nice add-on if you actually ever collect it. But it's not giving you a really good understanding of where your cash position is if you're carrying very large amounts of old AR, or if you're carrying very large amounts of old WIP. So make sure that you track, manage, and actively engage with these accounts, and make sure that we teach our project managers the importance of this so that they don't put projects on hold, or they don't put things on hold in WIP. You know, engage them if it's about collecting cash. So this to me is like one of those things where people often don't think much about this, but it's critically important, especially with WIP. If you're not tracking it today, hopefully you'll start thinking about this tomorrow or after this webinar.
So we went over the why part to benchmark. Now we're going to talk a little bit about the how to benchmark, the physical part. Kate didn't mention, but in a previous life, she did a lot of benchmarking and database management for various folks out there. So this slide that I mentioned before about the anticipatory thinking and the gap analysis, we're really talking about this front end right here. So Kate's going to go through the six best practices of benchmarking that I think have withstood the test of time, really kind of best practices out there for the AE industry.
Thanks, Brad. So one of the most important parts of this, and just so you know, I'm pretty passionate about benchmarking, so this stuff is all super important in my world and in helping you do better in your own company. So really the most important step is make sure that your data is comparable. If we're talking net revenue, make sure you're looking at a benchmark that's talking about net revenue. Make sure that you calculated net revenue the same way that net revenue is being calculated in that particular source. So make sure that you have apples to apples, basically. When it comes to benchmarking, less and sometimes be more. We don't need to benchmark. I can tell you that, you know, in some of these sources, there are thousands of data points. You don't need all of those. Maybe you need 10, 15, 20, 25, but you definitely don't need all that are possible. Choosing relevant peer groups. The reason this matters is because when you're benchmarking, you want to pick those peer groups that together best reflect your business model. So that's incredibly important. If you're a 20-person firm, you do not need to benchmark yourself to a 500-person firm, right? If you're an architect, you don't want to benchmark yourself to engineering sub-consultant or engineering prime. None of that matches your business model. So we also want to understand and pick operational levers that matter. So we're going to actually talk a lot about that today. But we want to know in the benchmarking, it's nice to benchmark, but what do I do? You know, where can I look for where I can make changes? Once you have those levers identified, then make sure you create an action plan. And then we're all about the anticipatory approach. So, you know, try to be proactive versus reactive. Don't let things get too far out where you haven't looked at your benchmarking for 6 months, you know, 8 months, a year. All of a sudden you're like, what happened? What did, you know, let's try to be proactive and let's get on it so that we can adjust the outcomes. So some of the key data sources are PS&J resources. As Brad mentioned, I was actually involved with this for about 5 years. And so I know this data very, very thoroughly and appreciate, you know, the creator of it, and it's been around for over 40 years. So the thing to think about any of the data sources is a lot of time when they have a 2022 report date, that means it's for fiscal year end 2021, because the goal of this is we wait for the books to close and then collect the data. I think really important is that PS&J is still collecting data. So again, when we get the copy of the webinar, there'll be a link if you do want to participate, and I highly encourage you to participate. The more firms that participate, the better the data. PS&J also selects their highest performing firms by pulling their top 20% out of the entire data pool forward, or data set forward. And what I like about this a lot is that it's not just who had the most growth or most revenue or most profits. It's actually on 13 different aspects of a business, and truly it's a well-run business. I've been involved with it for a long time. I used to pick these firms with my colleagues' help. And what I like about it is it talks about overhead, it talks about revenue growth, project performance, staff utilization, even turnover. So it is a well-run company that gets into the circle of excellence. And there's no particular firms that are overrepresented in that. Architects, engineers, all firms of all sizes are well reflected in that. When we talked about coming to the peer groups, this is how PSMJ breaks out their data. The very top line, this is operating overhead rate before incentive and bonus. The very top line is overall. And we'll talk about the percentiles, but you'll notice there's a 25th percentile, a median, a mean, and a 75th percentile. We never benchmark to the mean. That's a mathematical average, doesn't have a lot of value. But what you'll notice is that we have it broken down by firm size. So staff size 1 to 20 through over 750. There's practice area, location of the country, client types, private, public, or mixed, and then some data for markets as well. So if you primarily practice in healthcare or transportation, then there's some numbers for that as well. So it's important to pick your peer groups that best match your business model. Deltek also puts out the clarity report. Again, be careful and know when your fiscal year ends. It's a 2022 report. I believe they just closed for participation on March 13th, unfortunately. So that means their 2023 data will be coming out soon, but their it'll be 2022 fiscal year end. Again, it takes companies 2 or 3 months to close their books. So that's why these reports come out a little bit later than like right after the first year. So looking at their peer groups, you'll notice across the top, this is actually 2021 fiscal year end. I just put that note at the top. But the red arrow points to all participants. So you again, everybody all in. It's useful, but not totally meaningful when it comes to benchmarking. They also report their top performers. And then firm size, they break it down differently. So 1 to 50, 51 to 250, et cetera. And then they have the 2 main practice areas. So, this data is usually sent out to all of the Deltek participant or all the Deltek users.
Sorry, got click happy there for a second. Sorry.
Okay, gonna move on. Zweig Group also does their financial performance report, and this is actually an updated cover of their 2023 report. They're still collecting data as well. So again, make sure if you can participate, it'd be great to have your data included in that as well. Again, their peer groups are just a little bit different. They look at firm size, firm type, and region. And then they also look at growth and profit corporation, whether you're public or private, and prime versus sub. So a lot of different ways to look at your data and break it down. And this is chargeability is what this is. But this is just a sample of one of the pages of data that you would get out of Zweig's financial report. As I mentioned before, we don't want to use the mean. The mean is just a mathematical average, and what it actually helps those who put surveys together do is look at the median and see if there are any major outliers. So if the median and the mean are not somewhere near each other, there's probably some data that might need to be pulled from the data pool. But this is a normal bell curve. Sometimes we want to be in the 25th percentile. The median is the 50th percentile. It means all the firms in the data pool, that 50% of them fell to the left and 50% fell to the right. And then on the right is the 75th percentile. Almost all of the benchmarks that we look at, you probably want to be somewhere between the 50th, 75th, or in the circle of excellence. And then often there's a couple like days turnover for collecting our cash or getting our WIP handled. We probably want to be closer to the 25th percentile. I wouldn't recommend going towards the 75th percentile. So you have to think about the kind of data that you're looking at. Do you want to be high or low? One of the most important things about benchmarking is that it's quantitative metric, but it doesn't qualify. We need to go back and ask questions. You might have firm philosophies and policies that say, hey, that's where it's going to be. A simple example is I may benchmark your firm and find out you're 50% chargeable. Well, often I would be like, oh my gosh, what's happened? Where's your pipeline? How come you don't have enough backlog? Do you have enough, what's going on? Do you have too many people? How come it's so low? But if I talk to you and I find out that you have a firm philosophy about that puts you in that 50%, that puts you at 50% chargeable, then that's okay. We may not want to move it. So it's really important to not just quantify, but also qualify whenever you're looking at benchmarking data. So we're going to start with the very first step we talked about was gap analysis and some operational levers. And with that, we'll jump into our second poll question. Kaylee?
All right, so the poll is launched and the question is performance metric the performance metric we focus on most in our firm is utilization rate, net labor multiplier, revenue factor or payroll multiplier, gross margin, and other. And if you are selecting that other, drop what that is in the questions panel so we can see what you are focusing on most. So same thing as last time, we will keep this open until about 85% of our crowd has participated, or if a minute elapses, whichever comes first. And we are already at 79%, so just need a few more people to participate and then we can move on. All right, closing and sharing the results with everybody so everybody can see how their peers have voted. And 43% say utilization rate, 20% say net labor multiplier, 13% are focusing on a revenue factor, 16% say gross margin, and 8% say other.
Brad, you want to jump in here first?
Yeah, no, I think you're up first for the net revenue per total staff. Everybody, we're going to share some actual metrics and where the industry stands right now. We'll go back and forth and show you some of these actual statistics that have come from the surveys. But I would say utilization rate was predicted as being the best one, highest one. Most firms really have a high degree of focus on utilization rate, and it's not something we shouldn't focus on, but we'll explain when we get to the operational levers how utilization rate is too much emphasis or too little emphasis can have some unintended consequences. Let's just leave it at that for now. So, Kate, why don't you start this first one?
Okay, so jumping in, the first one we want to talk about is net revenue per total staff. So what we've given you here is the data for the median. It's $159 or $160,000 per head per total staff per head. And the top performing firms, they're seeing about $192,000. So what does this mean? What's the math behind this? So again, when you're looking for levers, and me being an engineer for sure, I always look to the math. How can I affect the denominator or the numerator, right? So we always put the math down here in the little left-hand corner for anybody who's inclined to want to look over there. But in general, what this for me means, basically net revenue per total staff is, do I have enough net revenue running through my firm? So this is one of those real quick hits. I can tell if maybe I need to work harder on my business development. Maybe my timesheets are not correct, right? Because it doesn't become net revenue unless it gets charged to a project. Maybe my billing rates or my fees may need review. Maybe we're not going out and collecting change orders, like I said. So, it's never getting to revenue, right? It's just sitting in WIP or it's not being acknowledged. Or maybe I have too many staff. If I had a really low net revenue per total staff, maybe I'm overstaffed at this point, and that would take some further analysis. So these are just places to look. And I would say there's usually not any one of these levers that impact. It's usually a little bit of both and, or a little bit of each of these things.
Right. I don't know many firms that have too many staff these days, right? That's that would be
no problem. Not a problem.
Next metric is your all favorite. Everyone said was most looked at. So median utilization rate, and again, payroll dollars, not hours. This is crucial. It's 58.2% for the median firm. Top firms are more in the 64% range. But the big challenge here is that the direct labor dollars divided by total labor dollars is the proper math behind utilization rate. A lot of firms do hours, and it's not wrong necessarily, except that it equates all hours to be equal cost. And the challenge with that is, of course, that many of the most highly paid people in an AE firm are the ones that are least billable. So most firms will give themselves a false sense of accomplishment, of security in their utilization rate by calculating it on hours. And if you haven't calculated it on dollars before, be prepared to see that percentage knock its way down a little bit. Again, on the operational levers, I think we could list, maybe not the balance sheet ones, but inaccurate timesheets are probably top of the list for all of them, right? Inaccurate timesheets is kind of the table stakes for good benchmarking. But your business development results? Are you keeping everybody busy? Are you being effective with the amount of time that's being put in business development relative to the workload that results from it? That lack of project work would come from poor business development results and people sitting around. And we don't really see that much today of people not having enough to do. But when people are nervous about when their next job is coming, they tend to take their current tasks and stretch them, right? A task that might take 3 hours now takes 4, or a day's worth of work becomes a day and a half. And all of that then starts to drive up that direct labor and gives you the false sense, of course, that people are being more billable. And that's why labor utilization is not always it should never be a standalone metric, but the problem with it is that it can give you a false sense of how much revenue you're producing as opposed to just how busy everyone is, okay?
Right, so that's where they spend their time, right?
Yep.
That's where they spend their time, but now the next thing we want to know is, great, so could that time actually go out on an invoice? And so we look at the net direct labor multiplier achieved. Most firms set a target, but what we're looking for is the achieved. So again, nice thing is literally this set for, well, the target set for like 30 years at 3.0 and then did a little bouncing around, and then we had the 2008 downturn. So it's nice to see it around 3.23. You can see the top firms are actually, again, this is the median for the top firms, hitting about a 3.67. And the math behind that is your net revenue divided by your direct labor. So for me, when I saw the results of 43% said utilization rate and 20% said net labor multiplier, I would encourage you to do both and. Because if, like Brad said, if you push on just utilization rate, sometimes you'll get unintended consequences that people will make sure they're highly chargeable. But that doesn't mean that it can go out on an invoice. And so this gives me a better feel for how much of that could I recover with my net revenue, of that direct labor, how much of it actually turned into net revenue. Again, like usual, starts with timesheets and business development, fees and billing. So anything that's driven by net revenue usually hits those buckets, but it also, you may need to look at the cost of your labor, right? We know that labor's been getting more and more expensive. It's been harder to get people in, so we might need to periodically do a check on our cost of labor to make sure that our direct labor is not higher than our peers and we're not producing our work at a much higher cost than our competitors are.
Great.
So with that, I want to show you just a little bit about what's in a net direct labor multiplier. So when you're looking at a multiplier, let's try 3.0. Let's say I pay someone $50 an hour. And let's say that they're 50% chargeable. So $25 of that's going to go into direct labor costs. So I have to count that here. The next one, they're indirect labor. So $25 is going to be part of that indirect labor. And then we're going to have the rent and the technology and benefits and insurances and everything else it takes to run a company. And then finally, hopefully on top of that, I'll have some profit. So if I bill the person out, if I paid them $50 an hour, and let's say I had a 3.0 multiplier and I billed them out at 150, my hope would be that not only am I covering their labor costs between the blue bucket and the green bucket, I'm also covering all my costs and there's leftover for profit. We can look at this at an individual level. We can look at it on a firm level, on a team level. You can look at it on a project level, in all honesty. Getting that billing, getting the multiplier is one of the most important concepts for people to understand and be able to proactively know how to manage this, especially with the increasing salaries. We have to make sure that our billing rates, for example, are keeping up with that multiplier. Go ahead.
Sorry. So we mentioned, of course, the challenges with looking at utilization only. Kate just explained why the multiplier is a good balancing metric to that. If we take both of those, this is my favorite metric. If I was answering that previous polling question, I would have said net payroll multiplier. Some firms refer to this as revenue factor. This is simply your net revenue over your total labor, or you can also calculate this by taking your achieved multiplier, labor multiplier, times your utilization rate. So just some quick math. If your multiplier, as Kate just referred to, for 20 years was 3.0, and you had a 60% utilization rate, you'd have a 1.8 net payroll multiplier. And lo and behold, that's about where the median of the industry is. 1.86 is where most firms live. The top firms are north of 2.35. And this makes a really big difference to your bottom line. This is the amount of revenue you produce dollar-wise for every dollar of labor that you spend. So this encompasses both your philosophy, your practices in multiplier, your billing rates, and how busy you're able to keep all your people, and the philosophy about how many hours people are putting in that utilization rate. So again, accurate timesheets, business development, tracking your change orders, cost of labor. The big benefit of tracking your net payroll multiplier is that this applies to all firms. If you have a high fee, low utilization rate economic model, or you're very, very billable, maybe up in the 70, 75%, but your clients will only let you charge a 2.4 or 2.5 multiplier, all of that gets balanced out in the net payroll multiplier. And I've always considered the holy grail of revenue factor a 2.0. If your overhead is being managed, as Kate said, we got to keep our overhead low, and she's going to show you those statistics here in the next slide. A 2.0 revenue factor will generally result in about 20% profit. And again, that's a big broad brush over a lot of the industry, but this is a very important and very meaningful metric for firms to track.
So operating overhead rate, and again, we have to be clear about what we're including in overhead. So this is before incentive and bonuses. One comment about this, I'll tell you, usually employee bonuses are included in your operating overhead because that tends to be, you have to pay bonuses to keep the company running. The owner bonuses or the principal's bonuses tend to go down below the line because and below the line just means it's not included in your operating overhead. So, again, the median is showing up at about 164%, and the median for the top firms is about 138%. And the math behind that is total overhead divided by direct labor. The number one contributor when you start to see this usually kind of running amok is because we have a lot of indirect labor for some reason. That's usually the culprit. All of your other expenses are fairly well set. You're paying the same rent, you're paying the same insurance, everything else pretty much stays the same. But managing that project work so that people have plenty to work on, so that they are spending their time on projects and not necessarily on overhead. And I'm going to say that with a caveat. You still need overhead time for training. You still need to send them to conferences. You still need to develop, and there is a need for overhead. You just have to manage it, and you have to make sure that we're not inadvertently getting indirect labor because people don't have anything to stay busy on.
Yep. One of the other very popular metrics out there, everyone wants to know net profits, right? Operating profit as a percentage of net revenue. Actually, the industry's been doing pretty well lately. The median at 18.3 is pretty high historically over the 25, 30 years that Kate and I have been doing this. But here you see the multiplicative effect of all of the other metrics being well watched and managed. Top firms are almost twice as profitable as the median firms because you get all of the benefits of watching utilization, multiplier, overhead rate. If you're good at all of them, those top firms really see the benefits of tracking that. And of course, operating profit divided by net revenue is what we're talking about. Again, that operating profit is before bonus and taxes, and bonuses include owner bonuses, owner distributions. But this is the ultimate kind of bottom line metric. So therefore, it's kind of hard to benchmark it for operational effect. Like, our profit is too low, what should I do? Well, there's tons of things that you can do. Your overhead might be too high. You might be having trouble controlling your labor costs. Your project management might be inefficient. You might be spending too much time and energy on jobs that you don't win. There's hundreds of them. So it's good to know this, but it's kind of hard to operationalize a benchmark about bottom line operating profit. That's why we went through the granular pieces of benchmarking first, because all of those added up. If you do well in all of those, it's hard not to have a good profit if you're paying attention to the details.
So let's move over to the balance sheet, because we talked about this earlier about WIP, and this is basically average work in process. And Brad, you have to explain 4 days for everyone, because it's like basically it never sits in WIP. They're always billing.
Yeah, I think some firms have continuous invoicing. I've experienced firms that send out invoices every week. Now, not every client doesn't get an invoice once a week. The invoices per client are 30 days, but they're billing on a constant basis in order to get the amount of volume out, get the WIP out. Also, down payments, payments up front count in accounting terms as negative WIP. So if you take your total WIP that you've got sitting in their balance sheet as an asset, you've got the deposits that you've received from your customers on the liability side, you owe those companies work still. You net those two out, you can drop the WIP days down significantly.
Great, thanks. We can move on.
Talk about accounts receivable then.
Okay, accounts receivable. This is again, how fast does it take to turn our invoices into cash, right? So are we getting our invoices out the door? I'll just share with you a really quick story. When I started my own MEP firm, right, I'm a starving startup. And I had one major client I worked with, and it was for a big healthcare system in another state. And to be honest, I went down and sat with that architect and I reviewed all of my invoices to make sure they weren't going to kick them out. Because then I had to get through the next threshold, was then are they going to get to the hospital? Or are they going to kick them out for expenses or something like that? So I did everything in my power to make sure they were as clean as they could, so that I made sure they got through so it would turn to cash. You know, so some clients are starting to bill their clients more than one time a month. Sometimes this is a story I just shared. Let's meet with key clients, make sure they got our invoices, make sure that the invoices are, you know, in the right part of their cycle for whenever they're getting ready to bill the client. The whole goal is to avoid rejection and delay. And then encourage your project managers to assist in collections. Sometimes they can say, hey, you know, we're not getting paid, what's going on? Usually when you're not getting paid, it means potentially something's not going well on the project. So it's worth digging into a little bit deeper and learn a little bit more.
Great. Next section, everyone, we're going to talk about the people side a little bit. We talked about projects and people being the top of the list of the things that we work on. This data is all great sitting on a report or on your dashboard, or I mean, if anybody prints them out anymore in a piece of paper, but you've got to get this information into the people's hands that can use it, right? And actually influence the performance of your firm. Now, that can be done effectively, and it can be done to great damage to firms as well. So we're going to talk about a little bit quickly through here our recommendations on sharing financial data to improve the performance of your firm. But we do have our third polling question first that is related to this, and I'll connect this polling question to the data coming up, but I would like to see your answers on this question first.
All right, so the poll is launched and the question is, the achievement of specific financial goal is connected to the compensation for, and please select one, and your answers are nobody, owners only, owners and senior managers, owners, senior managers, and PMs, and everyone. So same thing as the last two. I'll leave this open till about 85% of our crowd has participated, or if a minute elapses, whichever comes first. And we're already at 76%, so everybody's sticking with us this afternoon, which is wonderful. So just need a few more people to participate, and then we will close and share the results with everybody.
Great. Looks like it's tracking kind of what I expected. We'll see here. That's the way
All right. Closing and sharing the results. And more than half, 55% said everyone, 10% say owners, senior managers, and PMs, 12% say owners and senior managers, 7% say owners only, and 15% says nobody.
Okay, well, that's good. You've got some targets that need to be met in order to pay out bonuses, and everyone benefits and contributes at the same time, we hope. However, we find in a lot of firms, most companies, most employees in companies don't get access to these ratios, don't understand the metrics that we've gone through, and really don't understand why they got the bonus that they got. And the reason, one of the reasons we want to talk about here is transparency of this data. Now, we're not talking about transparency of your financial statements. Remember, we're talking about ratios. We're talking about utilization rate, achieved multiplier, revenue factor, those things. We must educate everyone first. Oh, and I forgot to mention, if you read the blog that we put out leading up to this, you saw the EIEIO principle. That wasn't really intentional until we got this process laid out. And I said, hey, that goes EIEIO. You got education, information, engagement, incentive, outcomes. I guess old McDonald has an AE firm now or something, but we want to make sure that this is the proper order for making sure that your people can use the data that they receive from this benchmarking process, okay? Go through these quickly. Education. KPIs must be taught. Most of you said that everybody gets less than 5 hours of training on financial stuff. Well, if you'd like to hold people accountable for some financial results, they need to know the why, they need to know the language, as Kate talked about. A lunch and learn is a very effective way to do it, but be very careful because education creates expectations, right? Now you're telling people about these numbers, the firm has to prioritize or has to make it important to keep calculating them in a consistent way and keep the information flowing, which is step number 2. Again, we're sharing ratios. It's important to keep it simple. This is one of those 6 keys to good benchmarking where Kate said less is more. You do not want to bury people in 25 metrics all at once. Start with the easy ones. Start with the ones that are easiest to teach and easiest for your accounting system to generate. And then, of course, as we mentioned, teach the terminology, that those words matter, that we're not using hours in our utilization rate, or we're not talking about our gross revenues when we really mean our net, or our payroll costs are being used instead of direct and indirect labor. It's very important to make sure that the information is tied to that education. Next, then, of course, I would consider this probably the most important step, is reinforcement by management in the day-to-day work to drive engagement. The levers that we talked about in each of those metrics truly do work, but management can't make those things move all by themselves. You need everyone in the firm to be, use an overused analogy, rowing in the same direction, right? Most of the levers that we talked about are project level, so those can be impacted by your project teams, and you have to set the expectations for, are you benchmarking against the median in PSMJ? Are you benchmarking against the circle of excellence? Are you benchmarking against yourself from last year? All of it can be effective, but again, we don't want to lose the why, and we have to keep reinforcing the importance of this. Once you've got engagement, which comes from education and the flow of information, now we can talk about maybe incentive. And I would like to predict that the 55% of you who said that certain financial metrics have to be met to pay a bonus is looking at profitability, right? If the firm doesn't make a profit, we don't pay a bonus. That's kind of elementary. But remember, profit is a macro measurement, right? There's so many things that go into this. It's not really a good incentive. It can be a reward. It can be a, well, we made our target so everybody shares, but it's not tied to specific behaviors that can incentivize additional behaviors or better behaviors that drive more profit, right? We want to make sure we've got the engagement. We don't want competition. And we do want to make sure that if they have the responsibility for a number, they have the authority to manage the behaviors that are driving that number. Then we'll see the outcomes. Micro moves for remarkable results. We love James Clear and Atomic Habits. If you haven't seen that book or read it, little tiny changes build on each other, and you can become a circle of excellence firm 2 times as profitable if you take care of this stuff, okay? Bottom line is investments in transparency pay off. Do not be nervous. Do it the right way. Share the education, share the information, get the engagement, put a little money behind it, and you'll be amazed at how these numbers change and how your firm performance increases. So with that, throw it out there for some questions. We've got a little bit of time, about 5 minutes before 3 here Eastern time. While you're putting out questions in there, if there are going to be any, we've got some participation deadlines that Kate touched on earlier. We just want to drive those in your heads again. The benchmarking is only as good as the volume of information we can get out of the industry and into the surveys. So please consider, if you haven't already done so, connecting up with PSMJ, with SWAG, or both, and making sure that you get your data in the sample so that you can benefit from that larger pool. Oh yeah, sorry, we do have another webinar coming up on April 6th. Our cohort, Scott Butcher, put out a blog today, I think, actually, or maybe it was yesterday, about seller doer skills. And Kate and I have our information here at the end. Feel free to reach out to us by email or through LinkedIn there anytime you've got questions that you thought of after the webinar. So, we got any questions in the mix there, Kaylee?
Oh, we have tons. We could be here for probably another 30 minutes. So
right.
I will just ask, kind of a general question, and the more specific we can answer offline. So it says, whose benchmarks are being used here, PSMJ, or is it a, variety of benchmarks?
These were PSMJ's data because I had the easiest access to those right now.
Okay, and another question that's kind of general, which factors determine the best match of peer groups?
So it depends, but always pick by firm size. Firm size does matter a great deal. The smaller firms don't even necessarily always have good accounting systems. And the larger firms, they have multiple departments, multiple offices, those kinds of things, and also by practice area, I would say. So that make sure if you're an architect, you're comparing yourself to other architects, if you're an architect with interiors, or, the different practice areas that came between the two. The other thing I would say, when you get to the client types, for example, mixed private or government, I would maybe pull in the government number, and you can weight these differently, right? Like if it's a certain number for firm size and it's a certain number for practice area, and it's a certain number for, you can take the straight average or you can do weighting. But I know with government, they have, that cost plus, there's a whole different model for a lot of government work. So I've definitely pulled that into that data as well.
Alrighty. And how often should firms be evaluating these benchmarks? Monthly, quarterly, annually?
I would say that depends on size also. In a small firm, one major invoice or one major project can have a huge difference on a monthly result. I usually looked at them quarterly at a minimum, because you might have a good month, you might have a bad month, and then the third month would kind of balance that all out. So quarterly at a minimum. With our small firms that we do the accounting for, that's the way we do it on a quarterly basis. But I know many large firms, because they have very diverse businesses and we work in all parts of the country, a monthly benchmark is fine. Certainly more often than annually, right? once a year, you get to the end of the year, you don't like your metrics, you're already at the end of the year, how are you going to change them, right? So that's definitely looking in the rearview mirror. So we got to stay anticipatory if possible.
Alrighty, and it looks like we're just about out of time here. So I wanted to give you, Brad, and Kate a little time to do some ending announcements, if you have any.
Well, if you've noticed, we do webinars all the time, so we'd love to see you out there. I mentioned one that's coming up in April, but there will be many, many more and related ones to benchmarking, strategic planning, with valuation coming up, performance improvement across the board, lots of other things, but we really appreciate it. It looks like there was 190 some of you logged on, and most of you stayed until the end. So we really appreciate your attendance and glad that you were getting something out of our information today.
Yeah, thank you so very much. Thanks for joining us.
Oh, and if your question did not get answered, we will get back to you by email with an answer. So we understand we got flooded here at the end. We will not leave you hanging with your answers, we promise. Thanks again.